Listen, I want you to picture something real, not a hypothetical, not a made-up story, a real American retirement, a real morning, a real surprise that thousands of retirees are discovering right now. Scottsdale, Arizona, Tuesday morning, April 14th, 2026, 7:18 a.m. Michael Turner is 71 years old, retired aerospace engineer, married for 43 years, 2 grown children, 3 grandchildren, the kind of man who still wakes up before sunrise even though he no longer has a job to report to. Michael is sitting on his backyard patio, coffee in one hand, reading glasses in the other. The desert air is cool, the golf course behind his home is quiet, and sitting beside him is a framed photograph, an old photograph. Michael and his father standing in front of the first house their family ever owned, a small ranch home, nothing fancy, just a symbol of what hard work could build. Michael smiles when he looks at that picture, because his father taught him something. Save, plan, be responsible, don't waste money, don't gamble your future away. Michael listened for decades. He did everything right. He maxed out his 401k every year. He delayed Social Security. He avoided credit card debt. He paid off his mortgage early. He invested consistently. He never chased get-rich-quick schemes. He never bought the fancy car. He never tried to outsmart the market. He simply followed the rules they told him would create a secure retirement. And by almost every measure, they worked. Michael accumulated more than $2 million in retirement accounts. More than enough, most people would say. A success story. The American dream. The model retiree. Then his CPA called. And suddenly the story changed. The conversation lasted less than 20 minutes. But those 20 minutes completely changed the way Michael viewed retirement. Because his CPA showed him something he had never seen before. Something nobody had ever explained. Something that becomes more dangerous the larger your IRA grows. A tax projection. Not for this year, not for next year, for the years ahead, when required minimum distributions begin. And when Michael looked at the numbers, he thought there had to be a mistake. There wasn't. The projection estimated that future required minimum distributions could push an additional $47,860 into taxable income over the coming years. Not because Michael made a bad decision, not because he broke a rule, not because he invested recklessly, but because he followed the rules too well. Think about that. For decades, retirees are told to save more, invest more, build larger retirement accounts. Then one day they discover that larger retirement accounts can sometimes create larger tax problems. And that surprise catches people completely off guard. Now let me be crystal clear. Having a large IRA is not a bad thing. It is a blessing. It means you saved. It means you planned. It means you sacrificed. But what many retirees never realize is that retirement planning does not end when the account gets large. In some ways, that is when a completely different game begins. A game involving taxes, income thresholds, Medicare costs, distribution rules, and government formulas that most people never study until it is too late. Michael stared at those projections again and again and again. The numbers didn't change. The reality didn't change. The future withdrawals were still there, waiting, quietly, like a tax bill hiding in the shadows. This is not the poverty penalty. This is not the middle class penalty. This is something different. This is what happens when retirement success creates challenges nobody warned you about. This is the success penalty trap, and I am about to expose it. Welcome back to the archive. I am the retirement insurgent, and today we are tearing the roof off one of the most misunderstood problems in retirement planning. The shocking reality that bigger IRAs can sometimes create bigger tax problems. And if you have accumulated a substantial retirement account, you need to hear every second of what comes next. But before we go 1 inch further, I need you to do something. Smash the like button right now. I am not asking, I am telling. Because financial education for retirees often gets buried beneath entertainment, headlines, and noise. And the people who benefit when retirees remain uninformed certainly aren't rushing to explain these rules. Your like helps put this information in front of people who genuinely need it. So hit that button right now. Then subscribe, flip the bell, join the archive, because what I am about to tell you, your neighbor probably doesn't know. Many retirees don't know. And even people with 7-figure retirement accounts are often shocked when they finally see the numbers. Now, the legal department would want me to say this. This video is education, not financial advice, not tax advice, not legal advice. Retirement planning depends on your income, your state, your assets, and your specific situation. Always consult a qualified tax professional, CPA, attorney, or fiduciary advisor before making major financial decisions. But understand something. The concepts we are discussing today are very real. They are based on current retirement rules, current tax rules, current distribution requirements, and they affect millions of Americans. By the end of this video, you are going to understand 3 things. First, why large IRAs can create tax challenges that smaller accounts often don't face. Second, how required minimum distributions can potentially affect taxes, Medicare costs, and retirement flexibility. And third, what strategies many financially savvy retirees explore before reaching RMD age. Because once you understand the mechanics behind this system, you stop looking at retirement accounts the same way. You stop asking only one question: how big is my IRA? And you start asking a much smarter question: how will I eventually get this money out? That question changes everything. And what you are about to see next should make every retiree with a large IRA pay very close attention. Because the real surprise isn't how much money Michael saved. The real surprise is what happened after he succeeded. Let's go to work. Now watch what happens next, because this is the part that should make you absolutely furious. For years, maybe decades, you were told a simple story: save more, invest more, build the largest retirement account possible. And to be fair, that advice isn't wrong. The problem is that it is incomplete. Because the financial industry spends enormous amounts of time teaching people how to put money into retirement accounts, but very little time teaching people how to get the money back out. And that omission matters a lot. The false belief is simple. Most retirees believe that a larger IRA automatically means a better retirement, more security, more freedom, more options. What they often don't realize is that under current rules, large traditional IRAs come with a future obligation, a future tax obligation, and eventually the government wants its share. That is where required minimum distributions enter the picture. For many retirees under current 2026 rules, RMDs begin at age 73. Not because you need the money, not because you asked for it, not because your lifestyle requires it. The withdrawal requirement exists because taxes were deferred for years. Eventually, the bill comes due. Look at the dirty legal trick they use. The government allowed decades of tax deferral. That sounds wonderful, and in many ways it is. But deferred doesn't mean forgiven. Deferred means postponed. The tax bill wasn't erased. It was simply delayed. And when your account becomes very large, that delayed bill can become surprisingly large too. After studying IRS publications, Secure Act changes, retirement account regulations, and planning strategies used across multiple states, the pattern is unmistakable. The bigger the traditional IRA becomes, the more important withdrawal planning becomes. Not because bigger accounts are bad, because bigger accounts create bigger decisions and bigger mistakes. Let me do the math live so it lands. Meet Linda, age 73, lives in Texas, recently retired. Traditional IRA balance, $2.1 million. Social Security income, some investment income, a very typical upper middle class retirement. Now look at the dirty math here. Linda reaches RMD age. Her first required minimum distribution is approximately $79,000. That money gets added to her taxable income. Not optional, mandatory. Now add Social Security benefits, add investment income, add interest income, add dividend income. Suddenly the tax picture begins to change. The income stack grows. And the higher the stack becomes, the more complicated everything gets. Now imagine that continues every year. The withdrawals don't disappear. The calculations don't disappear. The tax planning challenge doesn't disappear. In fact, for many retirees, it becomes larger over time. Because market growth can continue pushing account balances higher, even while withdrawals are occurring. Think about how strange that is. You spend decades trying to build wealth. Then one day your success creates a completely different planning problem. Not a savings problem, a distribution problem, a tax management problem, an income coordination problem. And many retirees never see it coming. They assume the hard part was building the account. Sometimes the hard part is managing what happens after. This should make you absolutely furious. Because almost nobody explains this during the accumulation years. Nobody sits down with a 45-year-old worker and says, one day this account could become large enough that withdrawal strategy matters just as much as investment strategy. Instead, people hear one message: save more, save more, save more. Then retirement arrives. And suddenly everyone starts talking about taxes, Medicare thresholds, distribution schedules, income planning. The conversation changes overnight. And here's where the real horror starts. Because taxes are only part of the story. The next layer is where things become even more interesting and potentially far more expensive. Who designed this? Who decided that retirees would eventually face mandatory withdrawal requirements from accounts they spent decades building? The answer is not mysterious. Congress, lawmakers, tax policy architects, and budget planners. The origins stretch back through decades of retirement account legislation, most recently through the Secure Act and Secure Act 2.0 changes. Why? Because retirement accounts receive significant tax advantages. The government eventually wants those taxes collected. That is the entire foundation. The system is designed to eventually move deferred retirement dollars back into the taxable economy. Not necessarily for your benefit, not necessarily for your convenience, but because tax deferral was never intended to last forever. This should make you absolutely furious. Not because retirement accounts are bad. They are not. Not because saving is bad. It is not. But because millions of retirees spend decades learning how to build wealth and almost no time learning how the withdrawal phase actually works. And ignorance is expensive. Very expensive. Who benefits? Federal tax collections benefit. Government revenue projections benefit. Budget planners benefit. Who loses? Retirees who discover these rules too late. Retirees who never planned for distribution timing. Retirees who thought account size was the entire game. It isn't. Account size is only half the game. Distribution strategy is the other half. Oh, friends, it gets so much worse. Because geography matters too, and most people never realize that. Let me give you the rule of three. 3 states, 3 completely different realities. California, Texas, Ohio. Same retiree, same account balance, different outcomes. California retirees may face both federal tax considerations and state income tax considerations. That can create a very different planning environment. Now look at Texas. No state income tax. Immediately, the retirement picture changes. Same federal rules, different state environment, different planning opportunities. Now consider Ohio. Different tax structure, different retirement treatment, different planning considerations. 3 states, 3 completely different realities, the same federal rules, wildly different outcomes. And that is why generic retirement advice is dangerous. Because your state matters, your income matters, your account balance matters, your age matters, everything matters. Tell me in the comments right now, what is your largest retirement account? Under $500,000? Over $1 million? Over $2 million? I read the comments every day. Your experience helps somebody else learn. Now pause this video. Send it to one friend, one sibling, one neighbor, someone who believes a bigger IRA automatically solves every retirement problem. Not tomorrow, today. Because one conversation today could save years of confusion later. And what comes next may be the most important part of this entire discussion. Because now we move from the problem to the playbook. Save this video right now. This is your survival manual. I mean that literally. Because someday your CPA may call, your advisor may call, or you may open an account statement and realize your retirement balance has crossed a level you never expected. And when that moment arrives, you do not want to be learning these concepts for the first time. You want a plan, a playbook, a roadmap. Now let us get to the strategy, the actual playbook. Because while many retirees focus entirely on building wealth, financially sophisticated retirees focus on something else. Control. Control over when income appears. Control over how taxes are managed. Control over future flexibility. Let's start with strategy number 1. Strategy number 1, Roth conversion planning. A Roth conversion is exactly what it sounds like. Moving money from a traditional IRA into a Roth account. Now, before anybody starts typing angry comments, let me be clear. A Roth conversion is not free. You typically pay taxes on the amount converted. That is the trade-off. You pay some taxes now in exchange for potentially creating more flexibility later. Think about why that matters. Traditional IRAs create future RMD obligations. Roth IRAs generally do not have lifetime RMD requirements for the original owner under current rules. That difference can be enormous. Imagine 2 retirees, same age, same net worth, same retirement goals. One retiree reaches age 73 with nearly all assets sitting inside a traditional IRA. The other spent years gradually converting portions into Roth assets. Who has more flexibility? Usually the second retiree. Because flexibility is power, and retirement planning is often a game of flexibility, not prediction, not certainty. Flexibility. Think of a Roth conversion like moving furniture before a hurricane arrives. You are not predicting exactly what the storm will do. You are creating options before conditions become difficult. That is the goal. Options. Not guarantees, options. Strategy number 2, strategic withdrawal windows. This strategy gets almost no attention, and yet it can be incredibly important. Many retirees experience years between retirement and RMD age. Those years can create opportunities. Income may be lower. Work income may be gone. Social Security may not have started yet. Or income may simply be lower than it will be later. That matters, because lower income years can sometimes provide planning flexibility. Imagine retirement as a staircase. Most people assume every step is identical. It isn't. Some steps are higher, some steps are lower. Some years create opportunities that never return. The retiree who recognizes those windows may have more choices available. The retiree who ignores them may eventually discover that those opportunities disappeared forever. Again, notice the pattern. The theme is not avoiding taxes entirely. That is not realistic. The theme is creating flexibility, because flexibility often leads to better outcomes and better sleep, which matters too. Strategy number 3, qualified charitable distributions. Now, this strategy obviously applies only to people who already support charitable causes. But if that describes you, pay attention. A qualified charitable distribution, often called a QCD, allows eligible retirees to direct certain IRA distributions toward qualified charities. Under current rules, this can sometimes help satisfy RMD obligations while reducing taxable income. Notice what happened there. The same required distribution exists, but the path changes, the outcome changes, the planning changes. That is why understanding the rules matters, because rules create opportunities, not loopholes, not tricks, opportunities, legal opportunities, the kind available to retirees who take the time to learn. After studying IRS guidance, retirement planning case studies, and withdrawal strategies across multiple states, one pattern is unmistakable. The retirees who struggle most are usually not the people with the smallest accounts, and not the people with the largest accounts. The people who struggle most are often the people who never planned for distribution management. They spent decades building wealth, then ignored the withdrawal phase completely. And that mistake can be expensive, very expensive. Now let me give you a simple analogy. A large traditional IRA is like a giant reservoir behind a dam. For years, water quietly accumulates. Everything seems calm. Everything seems stable. Everything seems under control. Then eventually the gates begin opening. The larger the reservoir becomes, the more important those gates become. The issue is not the water. The issue is managing the flow. The issue is understanding where the water goes once the gates open. And retirement accounts work much the same way. The account balance is only part of the story. The distribution strategy is the rest. Now let me show you something that makes this lesson impossible to forget. Because the difference between planning and not planning can become painfully obvious when you compare two retirees side by side. And that comparison is coming next. Let me show you two retirees. Same age, same state, same retirement date, same account balance, same market conditions, same opportunities, but two completely different outcomes. Watch carefully, because this is where everything we have discussed starts to become real. Meet Michael, age 73, Arizona. Traditional IRA worth $2 million. Healthy, financially responsible, retired. Now let's create two versions of Michael. Michael type A and Michael type B. Same person, different decisions, very different results. Michael spent decades building wealth, but he never focused on withdrawal strategy, never discussed RMD planning, never reviewed future tax projections, never evaluated Roth conversions, never examined future Medicare thresholds. His thinking was simple. My account is large, I'll be fine. And for years he was, until age 73 arrived. Then the mandatory distributions started. The withdrawals increased taxable income. Additional income began stacking on top of Social Security. Investment income continued flowing. Tax complexity increased. The planning opportunities that existed 5 years earlier were gone. 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 Michael wasn't broke, not even close. But he suddenly found himself reacting, instead of planning, responding, instead of controlling. And every year became an exercise in managing consequences rather than creating options. The result? Over a decade of retirement, Michael's family could potentially see tens of thousands of dollars in additional taxes and related costs compared to a retiree who planned earlier. Not because Michael was irresponsible, because Michael started too late. That is the tragedy. The mistake was not saving. The mistake was assuming saving alone was enough. Now let's rewind. Same Michael, same Arizona home, same $2 million IRA, same retirement date, same life. But 5 years before RMD age, Michael decides to get serious. He meets with qualified professionals, reviews future income projections, studies withdrawal timing, examines tax diversification, creates a multi-year plan, not a guess, a plan. Every year he evaluates opportunities, every year he adjusts, every year he increases flexibility. Nothing dramatic, nothing exotic, nothing risky, just planning, real planning, intentional planning. By age 73, Michael has more options available, more flexibility, more awareness, more control. The future is not perfect. No retirement plan ever is. But he is making decisions, not reacting to them. That difference matters a lot, because retirement planning is often less about finding the perfect strategy and more about avoiding unnecessary mistakes. And many of the largest mistakes happen when retirees ignore the withdrawal phase completely. Now let's compare the two outcomes. Type A spent decades focused only on accumulation. Type B focused on accumulation and distribution. Type A entered retirement with wealth. Type B entered retirement with wealth and a roadmap. Type A reacted. Type B prepared. Type A hoped. Type B planned. And over time, that difference compounds. Just like investment returns compound. Planning compounds too. Knowledge compounds too. Preparation compounds too. Same retiree, same account balance. Different decisions. Potentially tens of thousands of dollars in difference over retirement. That is the entire game. The financial industry spends enormous energy talking about how to build retirement wealth. Very little energy talking about how to manage retirement wealth. And that gap is exactly where costly mistakes are born. Now the question becomes, what should you do? Not next year, not after the holidays, not when you finally get around to it. What should you do tonight? Let's build your action plan. Here is what you are going to do tonight. Not next week, not next month, not after your next vacation. Tonight. Because every year you wait is one less year of flexibility. And flexibility is the real asset we have been talking about throughout this entire video. Most retirees think money is the asset. Money matters, of course it does. But flexibility is what determines how effectively that money works for you. And many retirees don't realize they're losing flexibility every single year they delay planning. So let's fix that right now. Step 1. Gather every retirement account statement. I want you to pull every retirement account statement you own. Every one. Traditional IRA, 401k, 403b, SEP IRA, anything with retirement money inside it. Do not estimate, do not guess, do not rely on memory. Look at the actual numbers. Write them down. Create a simple list. Account, institution, balance. Total them together, because you cannot plan for what you refuse to measure. And many retirees are shocked when they finally see the total number sitting in front of them. Some discover they have more than they thought. Others discover their assets are concentrated in places they never intended. Either way, knowledge creates options. Ignorance creates surprises. And retirement surprises are usually expensive. Step 2. Determine your RMD timeline. Next, determine exactly when RMD rules apply to you. Not when you think they apply, when they actually apply. Rules change. Laws change. Retirement regulations change. The date matters. The age matters. The timing matters. Because timing creates planning opportunities, or eliminates them. And once a planning window closes, it often stays closed forever. That is why understanding your timeline is so important. You need a calendar, not a guess, a calendar. Step 3. Estimate future retirement income. Now I want you to create a simple income forecast. Nothing complicated, just the basics. Social Security, pension income, investment income, rental income if applicable, retirement account withdrawals, everything. Put it on paper. Because many retirees look at accounts individually. The government doesn't. The tax system doesn't. Medicare doesn't. Those systems look at total income, the whole picture. You need to see the whole picture too. And when you finally see everything together, patterns start appearing. Questions start appearing. Planning opportunities start appearing. That is exactly what we want. Step 4. Schedule the conversation. This is the step most people skip. Do not skip it. Schedule the conversation. Whether it is with a qualified CPA, a tax specialist, a fiduciary advisor, or another professional familiar with retirement income planning, schedule it. Put it on the calendar. Pay the consultation fee if necessary. Because one good conversation today could potentially save years of confusion later. Many retirees spend months researching television prices, cars, vacations, kitchen renovations, yet spend almost no time understanding how a 7-figure retirement account will eventually be distributed. That makes no sense. Your retirement income deserves attention. Your future deserves attention. Your family deserves attention. The clock is already running. You simply may not hear it yet. Tell me in the comments which step you are starting first, and tell me your state. I always enjoy seeing where members of the archive are watching from. Now pause this video, send it to one retiree, one friend, one neighbor, one sibling, someone with a large retirement account who still believes accumulation is the entire game. Not tomorrow, today, because one conversation today may prevent a very expensive surprise later. You can be the retiree who gets blindsided by these rules, or you can be the retiree who understands them before they arrive. The choice is yours, and that choice becomes more important every year. Because retirement is not simply about building wealth, it is about managing wealth, protecting wealth, understanding wealth, and eventually transferring wealth in the most efficient way possible. Michael learned that lesson. The question is whether you will learn it before or after the surprise arrives. Remember, the problem is not having a large IRA. A large IRA is evidence of discipline, evidence of sacrifice, evidence of years of smart decisions. The problem is assuming that accumulation and distribution are the same thing. They are not. They are two completely different games. And retirees who understand both games often have far more options available to them. That is why this conversation matters. That is why these rules matter. And that is why I spend so much time bringing these topics to the archive. If this video helped you, smash that like button one more time on your way out. Help another retiree find this information before they need it. Subscribe, turn on all notifications, join the archive, because in the next video we are exposing one of the most overlooked retirement threats facing surviving spouses, the widow's tax penalty. And what happens after the loss of a spouse often shocks retirees who never saw it coming. You do not want to miss that one. I am the retirement insurgent. This was the archive. The trap was built for the retiree who does not know it exists. Now you know. Act accordingly.